Works. Awesome. Good afternoon, everybody. Welcome to Prediction Market NerdCon. I'm so excited to be here with all you guys, and thank you to the organizers and the sponsors. What a fantastic opportunity to gather with all of you and exchange some ideas. My name is Flip Pidot, founder of American Civics Exchange, one of the gray hairs literally in the space. Founded our company about almost 20 years ago. Been building platforms and tools for prediction markets ever since. And I basically have one goal today, is to convince you that prediction markets need a derivatives layer, right? The title here is the $250 billion missing link. And forgive any awkwardness. My assistant, whose name is Claude, drew up the slides here today. But effectively, my premise here is that prediction markets are now finally, long overdue, but poised to become a truly mature asset class in kind of the pantheon of global financial markets. And to do a really quick, brief history of prediction markets, right? So we talked about it a little bit earlier. John from Pidot mentioned kind of the proto-prediction market days in the 90s and 2000s where you had in-trade, right? The Irish based prediction market is available in the US, not entirely legal, kind of the same way that Poly was in its early days. If you followed that, it had a very strange end where the founder died on the slopes of Mount Everest, and there was lots of money missing from in-trade, but they'd also been sued by the CFTC a couple of times and shut down. But in any event, that was kind of the first real commercial foray into prediction markets around the world. You also had IEM, Iowa Electronic Markets, that operated under a no-action letter, which is the model that Pidot then pioneered into creating really the first commercial, legal way in the U.S. to trade on predictions. Political outcomes, elections, geopolitical, economic, and so forth. Not to delve too much into the muck and mire, but in 2010s, actually in 2010, Dodd-Frank, in response to the financial crisis, was enacted, and it did a couple of things. It banned what was a lighter weight regulatory footprint called the Exempt Board of Trade that we actually operated under from 2007 to 2010. They said, nope, that's gone. Right? You've got to either be a swap execution facility or you've got to be a DCM. They also banned box office futures. It was the second time that Congress banned a category of commodity futures. Onions and box office futures, the two things you cannot trade per Congress. It was from lobbying from the MPAA. The studios didn't want there to be a good signal out there that a big tentpole movie might be a flop. And the ultimate irony is that Chris Dodd of Dodd-Frank, upon retirement from the Senate, went on to become the chairman of the MPAA, and they have since lobbied to undo the ban, because they now see, I mean, they're of course the primary use case, right? You hedge against this potential downside of a billion-dollar movie franchise. And of course now in the 2020s, this is why we're all here, Polymarket, Kalshi, dozens of others, and the, I won't say wild, wild west, but kind of the heyday that we're in for hopefully another 1 to 3 years at least to really realize finally the potential of these markets. Really quick, just sort of philosophically about the way I think about prediction markets. So you got two kind of markets, right? You've got capital markets, you got risk markets. Right? Capital markets, stocks, bonds, it's all about the efficient reallocation of capital, right? The market creates value because two parties have a different risk tolerance, have a different time horizon, have a different cost of capital. And so by reallocating capital among them, it creates value for both parties. Futures markets are different. They reallocate risk efficiently, ideally, right? For largely the same reasons. You and your life insurance company, right? You might have different time horizon, different risk tolerance, different expectations about the future. This is really the hallmark of every futures market, is that it's a reallocation of risk. And the reason that we got into this, now nearly 20 years ago, was thinking about futures markets, that reallocation of risk, external risk, otherwise unhedgeable risk. The largest category, the otherwise unhedgeable category, or at least not by means that we like to, highlight, was policy risk, right? Tax rates, FDA approvals, tariffs, legislative decisions, and everything upstream and downstream of that, right? Upstream of policy decisions are elections, redistricting battles like we just seen in Virginia this week, and everything downstream of policy decisions, economic outcomes, geopolitical manifestations, stuff we see in the news, of course, every day. All of this, up and downstream from policy, public policy, is that one huge driver of external financial risk that you can't otherwise hedge. And this is why, again, it's sort of a founding philosophy. Our thought was that this must exist. This will exist, and we want to help bring this to fruition. So, this is what I just talked about. The ick factor, right? So, as I discussed a bit, this is the history of financial innovation, right? Any marrying of money or the economy or finance with sufficiently important societal matters is shunned, right? Is castigated. Life insurance, that gives someone an incentive to kill someone else. Yes, it does. And it's this, the basis of, thousands of dime store novels. That doesn't mean that the existence of life insurance is a negative net societal equation. It's, of course, foundational to modern day life. Same thing for equity indices. This is just gambling. This is just retail, playtime. And as I mentioned before, things like box office futures and onions. Anytime that someone wants to innovate financially, there's going to be blowback saying this is just a few years ago, even the CFTC, which is now happily suing states on behalf of the prediction markets to say these are rightful, societally beneficial markets within their jurisdiction, even just a few years ago. And we started harassing the CFTC in 2009 to say we want these markets to exist. And the answer has always been the same. The ballot box cannot become a casino. We won't be cops to regulate the elections, and elections are too important, too sacrosanct, too pure to subject to the dirty whims of money and finance. My opinion, I think probably most of your opinion here, is that it's too important not to subject to the whims of finance. If it's such an incredibly important and impactful financial driver that you can't hedge otherwise, or again, only by sort of unseemly means, right, to try and influence politicians' decisions or elections, it's too important not to allow risk markets, this centuries-old, tried and true mechanism to efficiently reallocate risk. So this is again kind of our founding philosophy, and it brings me to, again, my premise here today and what I hope to convince you of. There's two things I think missing that will eventually be solved in prediction markets. Number one here, I'm not going to really delve into too much detail about, but it's kind of a pet peeve of mine is to do with rules writing. I think we'll eventually settle on basically deterministic rule sets. This is something where I think Pauly, Kalshi, everyone sort of fails currently, and you get controversial or just bad settlements based on, frankly, foreseeably ambiguous rule writing. It hasn't become a huge issue yet, but if this asset class, which it is now, gone from academic curiosity to sort of a niche market to an asset class, is to become mature the way that oil futures or index futures or interest rate futures are, you can't have a situation where people are saying, well, I thought if Khomeini died, that meant he was out of power, and the other side said, it's only if he's removed from power without dying. You can't lay off $1 million, $10 million, $100 million risks and have bad rules. In any event, I said that's the part I'm not going to go into. Number 2 is the derivatives layer. So this is something that every mature asset class has. Equities, bonds, interest rates, hard commodities, soft commodities, foreign exchange. It enables you not just to bet on or invest in whether something happens or doesn't happen, right? But enables you to put on a much more nuanced, customized, specific strategy, right? So say J.D. Vance being nominated for president in 2028, being the Republican nominee, trading at, I don't know, say 50 cents. I think, or I've researched, or I have inside info, or I've caught whispers that some other candidate who sort of is, most likely rival is about to drop out, right? So I think in the next month, when this is going to happen, J.D. Vance is going to go from 50 to 70, right? I can buy him at 50. I can hold it for the next 2 years, right? I'm basically paying for the upside that I can experience over 2 years. Or I can buy a call option if we have a derivatives layer that says, okay, I'm buying the right to buy Vance at a certain strike price, right? So if I want to buy a call option on Vance at 50 that expires in, say, a month, I might pay, who knows, 2 cents, 3 cents for it. The market would decide what the premium would be for that option. But then I have a much more time-specific, narrative-specific bet, much more capital-efficient bet that I can make. And if he does go from 50 even to, say, 60, right, then I exercise that option. I buy it at 50, I sell it at 60, and that all happens kind of atomically as one transaction. I make 10 cents on each contract for my investment of 2 cents. So I've got a 400% return rather than a 20% return. But they do a lot more than just provide leverage, because that's sort of the leverage case, right? Puts and calls, vanilla puts and calls, the right to buy at a certain price, the right to sell at a certain price. And that's powerful. But you combine them, and now you can create option strategies, including spreads, collars, straddles, strangles. I mean, they get horribly complex. But the idea is, again, if you think Vance is going to go from 50 to 70, you don't want to pay for all the upside. He's not going to go to 100, but you're paying that premium, assuming he might go to 100. So you're paying for all that upside. Instead, you could buy a spread. I want to buy a call, right? I want to buy the option to buy Vance at 50, but sell one at 70, right? So maybe the 50-cent call cost you 3 cents, and the 70-cent call further out of the money would be valued at 1 cent, right? So you buy the 50 at 3, you sell the 70 at 2. Now you've got a 2-cent cost basis, and you still get that whole band that you're expecting over that month, 3 months, whatever it might be. Well, let's not jump to that just yet. Also allows, risk management and more nuanced strategies that investors, corporations, natural hedgers use in every other asset class. So, for instance, one's called a covered call, right? So say I own oil, or I own Apple stock, or I own the J.D. Vance to be nominated shares, and I own 1 million shares of it, right? So my position is worth $500,000. I'm not so sure that he's going to be nominated. I'm a little bit concerned about it. Well, what could I do? I could lighten my position. I could sell some of it. Or you could sell covered calls on it, right? So you can sell the call option. Let's say, again, it's going for 3 cents. And because you have an underlying position in it, if Vance goes down, the call that you sold is worthless, so you just collected the premium, and your position goes down, but by 3 cents less, right? If it goes up, then the cost of the call or the value of the call goes up in a way that matches the underlying position that you have. So it enables a very capital efficient way to play very different investment theses, or again, protect against downside, generate income from existing positions, and otherwise enable all the more professional and sophisticated investment styles that literally every other asset class enables. And as an example of this, and you can see down below, prediction markets don't register here, but this is the size of the markets that we're talking about. That 2.05, that's quadrillion. So on the bottom you see it's annual turnover of $2 million US, and that's 2 million of them. So that's 2 quadrillion is the annual turnover in interest rate derivatives. 1.7 quadrillion in foreign exchange derivatives. Crypto and prediction markets aren't there yet. Crypto is growing, perps are growing, perps on prediction markets are growing. But a derivatives layer, a functional, robust, capitally efficient, secure options layer on prediction markets will cause it to explode. I said last year at Manifest, in a talk I gave there, that I predicted in 2028 prediction markets would do $1 trillion in volume. It drew chuckles just 12 months ago. Now it seems inevitable that it'll do at least $1 trillion in 2 years' time. This derivatives layer takes it from $1 trillion to $1 quadrillion, because this is, like any other risk market, poised to be one of the largest, if not the largest, market in the world. And it all is driven, what I talked about at the top. You've got 2 market types, right? Efficient reallocation of capital and efficient reallocation of risk. The risk markets, globally, historically, for hundreds of years, dwarf the reallocation of capital markets, stocks and bonds. And the largest, the real driver is the hedgeable risk, right? And so this is why I get a little bit frustrated when I look at the likes of Polly and Kalshi chasing, crypto, sports, perps, because that's sort of these are the shiny objects. This is the stuff that's driving volume, it's driving revenue, so of course they have to. But I think it's missing, the forest for the trees. Why are derivative markets, risk markets, the biggest markets in the world? Why do they have numbers that start with Q, right? Not just T. It's because the efficient reallocation of risk is the most powerful, most valuable thing that markets can do. And policy risk and everything upstream and downstream, whether it's mentioned markets, redistricting, an election, a tax rate, an economic index, GDP rate, GDP growth rate, is all part of policy risk. And until a couple of years ago, there was no way to hedge it, or at least no way that we like to talk about in public. And so it will get there. It will become part of, and I think the principal part of, this pantheon of global financial markets. But we need options to get there. This is more on specific strategies you can employ with options, but we don't need to go into it too much. This is a zero-cost collar. For instance, this is an example. If you hold AOC to be the nominee or president in 2028. You can, for instance, buy zero cost insurance against it by giving up some of the upside, right? So if she's trading at 20 cents, you can buy a put and sell a call so that, you're not going to make 5x if she goes to 100%, but by selling some of your upside, you fund the insurance that you buy in the downside. So again, it just enables a lot more sophisticated professional hedging strategies that investors and global institutions are used to employing on every other asset class. This talks a little bit about the polyoptions architecture. Polyoptions is a company that I started. We do exactly this. We built an options layer on the Polygon network. It's on testnet now, but you can go in and play with it. You can buy and sell call options on the live underlying Polymarket shares. It's kind of a proof of concept, can be applied to other on-chain or off-chain prediction markets. We did this as part of the Polymarket Builders program, right? I guess they now call it the Polymarket Developers program. But we're hoping that this sort of gets people familiar with, and of course, right, if you talk to your parents, your friends, your siblings, or whatever, they might say, this all seems like gambling. I saw it on John Oliver. I don't know what the hell this is all about. It's just sports books writ large. It seems exotic enough, I think, to the average person on the street still. Prediction markets do. We're getting there. We're definitely getting there. But it's still exotic, right? And so options on them, options on event futures is, to a lot of people, a bridge too far, at least currently. But what we're hoping to do is to illustrate to the public, but also to the end users, right? To the market makers, to the institutional hedgers, that these products graduate prediction markets from yes, no, from a binary, to actually trading the path of probability, giving you so much of a more fine-tuned way to trade a given thesis or to isolate risk or isolate volatility. It was one of the other use cases here I didn't get into, but if you simply want to say, we'll go back to the J.D. Vance example, I simply think he's going to stay at 50, right, for the next year. You can sell a put and a call, collect the premium, and you profit as long as he just sort of stays around 50. Or you could say, look, I think the economy is going nuts, right? Something's going to break. It's either going to be great or terrible, right, from AI or whatever else. And so as a result, the Fed is going to massively raise or lower interest rates, or GDP is going to go way up or way down. You can just buy the volatility. You can say, I don't know which way it's going to go, but my thesis is that, things are going sideways one way or another. You can buy the volatility. You can buy it such that if things go up or down, you make money. One quick point here, too, in case you're curious, because this was a bit of a sticking point for us as we were contemplating the architecture of polyoptions, is the settlement print, right? So rather than traditional prediction markets, right, the thing happens or it doesn't. It settles at 1 or 0. And again, like Khomeini, maybe you're upset about the answer, but it settles at 1 or 0. With options on prediction markets, they settle before the end date. Again, you can pick your expiration. It might be a month from now, 6 months from now, a year from now, but it's going to settle according to the price then, right? So if I buy that Vance call option at 50, and it's at 70 when it expires, or whenever I want to exercise it, that's a profit of 20 cents to me, right? Because I exercise it, I buy it at 50, I sell it at 70, I've made 20 cents. How, if you have a relatively illiquid market, can you prevent against someone simply manipulating the price, saying, oh, I'm short millions of these shares, I'm just going to bid it up to 75 cents for a few minutes before it settles? What we do is physically settle all the positions. So you don't simply get the 20 cents, you get the yes token, right? So all this logic is encoded in the smart contracts. If you hold that long call option position on poly market and it resolves in the money, you don't just get the 20 cents. You actually get the token. You get that 70 cent, the token that's worth 70 cents now, and you only pay 50 cents. But then optionally, the trader can say, also I want to immediately liquidate it, right? Within a certain amount of slippage, right? So yeah, give me the token, but sell it immediately unless you can't sell it for more than, say, 68 cents or whatever it might be. This avoids and you see this on Manifold and other, play money and real money markets where they have things kind of marked to certain times, like the monthly contest, or you get promoted up a league or demoted down a league. And they set it to like a random time in the day following the end of the calendar month. Same idea though, right, is that you could go in and manipulate the price to sort of at that one flash have a better perceived outcome. This, we think, sort of solves or at least significantly addresses the issue of settlement print manipulation. So to close, again, I think this is a $1 quadrillion future for this market. I've been lucky and blessed to be part of it from the early dark days, pre-Dodd-Frank, through Dodd-Frank, and through this real heyday, which all of your attendance here is testament to. I'm extraordinarily bullish about the future of this asset class. I thank you all for being here. I thank you all for the work that you're doing. And I don't know how long I've gone. I'm happy to take a question or two, but I don't know if we've got someone coming up.